Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Dick's Sporting Goods stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Dick's Sporting Goods is a sporting goods retail company. The company is headquartered in Pennsylvania and was founded in 1948. It went public in 1985 and currently trades on the NASDAQ. It has 850 stores and is the country's largest sporting goods retailer. Let's get started with the model. This is a mid-cap company, $7 billion market cap. They're trading at $79 a share and they have 89 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has positive free cash flow each year, peaking in 2021 at $1.3 billion. Net income is the profit and loss on the income statement. It's revenue minus expenses. That's also positive each year, the highest in 2021 again. Revenue is the sales for the company, and that grew from $8.6 billion to $9.6 billion. So all their numbers are moving in the right direction. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. An example of cost of revenue is the payroll it pays to its employees at its retail stores. Revenue minus cost of revenue gives you your gross profit. That peaked in 2021 at $3.1 billion. Then below that is operating expenses. Examples are marketing and depreciation. Then below that is operating income. Their operating income doubled from 2020 to 2021. Then below that is the interest they pay in their debt. They paid the most interest in 2021 at $48 million. Then below that is other income and expenses. This is usually impairments or write-offs. Then you have your pre-tax income, then your taxes. And the bottom line of the income statement is your net income. And that was the highest in 2021 at $530 million. It was around $300 million for the prior 3 years. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. Then you have capital expenditures, which are investments in property, plant, and equipment. When the company purchases real estate to put up a new store, that dollar amount goes into CapEx the first year they purchase it. Then it's depreciated over time onto its income statement. Operating cash flow minus CapEx gives you your free cash flow. And they had a lot of free cash flow in 2021, $1.3 billion, more than the other 3 years combined. They do pay a dividend payment, but another way to reward shareholders is to buy back stock. When a company buys back stock, this decreases the shares outstanding, making your shares more valuable. They bought back $300 million in 2018, another $300 million, then $400 million. They do issue a little debt each year. In 2021, they issued $1.9 billion of debt and they paid down $1.5 billion. So they added about $350 million of debt that year. And the prior year in 2020, they added about $170 million of debt. Let's look at the capital structure. $2.3 billion of equity, $3.2 billion of debt. They have 43% equity, 57% debt. Their net debt is $1.5 billion. And their WACC is 9.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $9 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $8 billion. We divide that by 89 million shares. And we get a calculated stock price of $90. They're trading at $79, so they're trading at a 12% discount. It's a buy according to the model. Simply Wall Street is way higher than me. They're at 167, so they're saying the stock is really undervalued. In the past 3 months, 18 analysts priced this stock, and the average price was $80. The low was 58, the high was 100. So my valuation is closer to the high. This is a stock price the last 5 years. If you purchased this stock last year in March when the market crashed, it tripled since that point. The stock is currently trading at its all-time high. This company seems to raise its dividend each year. It was 15 cents in 2016, now it's up to 36 cents. They pay a 1.8% dividend yield. To calculate the dividend yield, you could just multiply the last dividend payment by 4, take that number, and divide by the current stock price. They pay out 24% of their net income and 10% of their free cash flow. Their dividend is higher than the industry average of 1.4%. The bottom 25% of the market pays a 1.3% dividend. They're above that. But the top 25% of the market pays a 3.5% dividend. Analysts are forecasting their dividend yield in the next 3 years to grow a little bit to 1.9%. Their beta is 1.72, so the stock moves almost 2 times the market. It's a bit volatile. The stock has gone up almost 400% in the past 52 weeks, while the S&P 500 went up 65%. The 52-week low was 14, the high was 81, and the stock is trading above its 50-day and 200-day moving average. About 1.5 million to 2 million shares are traded each day. Over 100% of the shares are held by institutions. The number can't be over 100%. This is just a timing issue with Yahoo Finance. A lot of people are shorting this stock. Over 18% of the shares on float are shorted. If you include dividends in the past year, the stock went up almost 400%, the industry 186%, and the market 84%. In the past 3 years, this company beat the industry and the market, but if you look in the past 5 years, this company is lagging the industry and the market. Analysts are expecting the company's earnings to grow less than 1%, while the industry over 31% and the market 19%. Analysts are expecting DIC's revenue to grow a little more than 2%, while the industry grows 11% and the market 10%. If you invested $10,000 into this company 10 years ago, you'd be at $24,000 today. That's a 9.3% annual return. The CEO of the company, Edward Stack, owns 15% of the stock, then FMR, BlackRock, Vanguard, and LSV Asset Management. Let's look at the financial ratios. The average PE in the market's 32, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 13.3, so investors are paying $13.30 for $1 of earnings. Price to sales is stock price over sales per share. They have a really good price to sales ratio of 0.7. Price to book is stock price over book value per share. They're at 3.0. Also another good ratio. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities in the balance sheet, and they have $2.3 billion of equity, $2 billion of tangible equity, because they have $330 million of intangible assets on their balance sheet. Interest coverage ratio is EBIT over interest expense. They're at 15.2, so they can easily cover their interest payments. ROE is net income over equity. They're at 23%. They have a great ROE. Current ratio is current assets over current liabilities. They're at 1.5. They can cover their current liabilities 1.5 times. And their current assets are $1.7 billion of cash and $1.9 billion of inventory. The company seems well capitalized. They had $1.3 billion of free cash flow. They currently have $1.2 billion of working capital, and they have a $129 million dividend payment. So they have $2.4 billion of funding. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 7 other companies in the same industry as DICS, and if DICS has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're better in every single category except market cap. Their market cap is $7 billion, the average is $9 billion. To summarize, I have them trading at a 12% discount. This company has been around for over 70 years. They're still profitable. They still have a lot of stores out there. And even during COVID, their sales are really strong. I rank their free cash flows 9 out of 10, their revenue 8 out of 10, and their ratios 10 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.